Okay, next one is flexible budget. What is meant by flexible budget? Flexible budget means a company is preparing more than one budget in one accounting period. Company is preparing either two budgets or three budgets at different activity levels. Company wants to evaluate that which one of the cost is stated as a variable cost, which one is stated as a fixed cost, or which one is the cost is semi-variable cost. So we use flexible budget to calculate the cost behavior, or we want to know the cost behavior. So a budget for semi-variable overhead cost only, then a budget based by recognizing different cost behavior patterns is designed to see the volume of activity changes, different cost behavior patterns. Purpose of flexible budgeting is to understand the cost behavior pattern. Next one is, what is the purpose of a flexible budget? To cap discretionary expenditure, no. To produce a revised forecast by changing the original budget when the actual costs are known. It is called revised budget, not the flexible budget. To control resource efficiency, to communicate targets to activity level within organization by setting a budget in advance for the period to which it relates. You can ask that it is a characteristic of a fixed budget, not the flexible budget. Flexible budget tells us what is the cost behavior, and it can help us to control the resources efficiently or with efficiency. What is the fixed budget? A budget for a single level of activity, not only for the single level of activity, we can say that it is restricted for a single time period. So this is the right answer. A budget used when the mix of products is fixed in advance of the budget period. A budget which ignores inflation and overhead cost budget. So this is the definition of the fixed budget. Which of the following statements are correct? A fixed budget is the budget that considers all of an organization's cost and revenue for a single level of activity. Yes, this is the correct characteristic of a fixed budget. Flexible budget is a budget that is produced during the period to recognize the effect of any changes in prices and method of operations that have occurred. Okay. Organization can use budget to communicate objectives to their managers. These are the two purposes. Second one is the incorrect definition of the flexible budget. Next question is to prepare flex budget. Now learn that how to prepare the flex budget. And whenever question asks you to calculate flex budget, you will follow the same pattern. O Press produces and sells textbooks for the schools and colleges. The following budgeted information is available for the year ending 31st of December 2086. Original budget is provided, actual is provided, we will prepare and one more column which is called flex budget. It is the requirement of the question, and in addition I am preparing one more column which is called variance. So now wherever you are required to prepare the flex budget, follow these principles and follow these principles to calculate variances as well. So budget is 120,000, sales revenues and costs are provided as 100,000. So divide 1.2 million by 120,000 and calculate budgeted selling price of $10. Variable printing cost 360,000 divided by 120,000. So we can call it 3. Variable production overhead is 60,000 divided by 120,000. It's 0.5. Fixed production cost will remain the same. Fixed cost does not vary with the budget or with the activity level. So now we are required to prepare flex budget. We will use actual activity level, which is 100,000, and we will multiply our budgeted selling price per unit and variable cost per unit with the activity level. So 10 is multiplied by 100,000. We are preparing with triple zeros, so we will say 1,000, which means 1 million. 3 multiplied by 300,000, it means 300. 0.5 into 100,000, it means 50. Budgeted cost will remain the same, 300 and 360. So now you can calculate what? You can calculate profit for the flex budget or loss from the flex budget. 300,000, 50,000, 300,000, and then deduct this value. So we have a loss for $10,000. But if I calculate actual result, here we have a profit of $5 or $5,000. Flex budget says that we have what? We have a loss of $10,000. Now we can calculate variances. Actual sales are 995. Flex budget says it must be 1 million. So we have 5,000 adverse. $5,000 as adverse variance, which means our actual sales are less than the flex sales. Variable cost actual is 280, flex was 300, so we have 20,000 favorable. 56 actual, we have 50 flex budget, we have 6,000 adverse. 290,000 actual, 300,000 flex budget, so we have 10,000 favorable. Actual is 364, flex was 360, so we have 4 adverse. So we can calculate what? 5 adverse plus 20 favorable is 15 favorable. Then further reduction of 6, now it's 9. 9 plus 10 is 19. Minus 4 means what? 15. So the variance is that we have a difference of $15 favorable. So here we have $5 profit, $10 loss. So difference between $5 profit and $10 loss, minus is plus, so you can say that difference is 15. So we have calculated in either way. We compared or we determined 3 things. First one is flex budget, then we calculated variances, and then we determined that difference between profit and the actual and flex budget. It is 15 in this way and it is 15 favorable. So we can say that our flex budget is correct, our variances are correct. Although the requirement of this question is just to calculate the profit and loss for the flex budget, so with respect to this requirement, B is the right answer. Now, whenever we have a question from the flex budget, follow these principles to calculate flex budget and the variance. Which of the following statement is true? A fixed budget is the budget that remains same from one accounting period to the next. No. To the next, not. A fixed budget is produced for one product for different level of activity. It is not fixed budget. It is flexible budget. A flexible budget is designed to change as the activity level changes. Yes. A fixed budget is useful when comparing budget figures with the actual. No, it is not fixed. A flex budget is actual. So if we change the question, then it will be the correct option. Choose the right option for 308. Next is to calculate change the flex budget. Now I have told you how to prepare the flex budget. Follow the same principles. When budgeting, what are the variable costs conventionally due to? Variable cost is the cost which varies with the level of activity. But remember one thing, per unit variable cost remains constant, either the activity level changes. We always say that per unit variable cost is fixed in its nature. Vary per unit of output as production volume changes. Be constant in total when production volume changes. Vary as production volume changes, not the per unit. Total varies, not the per unit. Be constant in total. Fixed cost means the constant in total, not the variable cost. It is the definition of fixed cost. Vary in total from period to period when production is constant. Again, it is not the definition. A is the right answer. Again, flex budget, same pattern. Once again, it is a flex budget, but it is provided in percentage terms. Or you can also use it as a high-low method and simply assume that it is 50 units and it is 75 units. You can follow the principles of high-low method. Budgeted overhead for the highest activity level minus overhead for the lowest activity level divided by difference between high and low activity level. So you can calculate what? You can calculate variable cost per unit or per percentage, which is 500. Then you can multiply it either with the highest level of activity or with the lowest level of activity. Suppose if we multiply with the lowest level of activity, our total variable cost or overhead will be $25,000. Now we can calculate total fixed cost or fixed overhead, $100,000 minus $25,000. Total fixed cost is $75,000. Now we are determining for the activity level of 80. So now y is equal to fixed is 75,000 plus variable is 500. So we can calculate total overhead. It's 115,000. Any question? Once again, we have the same next budget question.